These are all of O-Levels Economics Section 2 definitions in 8 minutes. Microeconomics is the study of the behavior and decisions of households and firms and the performance of individual markets. Macroeconomics is the study of the whole economy. Market is an arrangement which brings buyers into contact with sellers. Economic agents are those who undertake economic activities and make economic decisions. The private sector consists of firms owned by shareholders and individuals. Economic system is the institutions, organizations, and mechanisms that influence economic behavior and determine how resources are allocated. Planned economic system is an economic system where the government makes the crucial decisions, land and capital are state owned, and resources are allocated by directives. Directives are state instructions given to state owned enterprises. Mixed economic system is an economy in which both the private and public sectors play an important role. Market economic system is an economic system where consumers determine what is produced, resources are allocated by the price mechanism, and land and capital are privately owned. The price mechanism is the way the decisions made by households and firms interact to decide the allocation of resources. Capital-intensive production involves the use of a high proportion of capital relative to labor. Labor-intensive production involves the use of a high proportion of labor relative to capital. Demand is the willingness and ability to buy a product. Supply is the willingness and ability to sell a product. Market equilibrium is a situation where demand and supply are equal at the current price. Market disequilibrium is a situation where demand and supply are not equal at the current price. Market demand is the total demand for a product. Aggregation is the addition of individual components to arrive at a total amount. Extension in demand is a rise in the quantity demanded, caused by a fall in the price of the product itself. Contraction in demand is a fall in the quantity demanded, caused by a rise in the price of the product itself. Changes in demand refer to shifts in the demand curve. Increase in demand is a rise in demand at any given price, causing the demand curve to shift to the right. Decrease in demand is a fall in demand at any given price, causing the demand curve to shift to the left. Normal goods are products whose demand increases when income increases and decreases when income falls. Inferior goods are products whose demand decreases when income increases and increases when income falls. Substitute is a product that can be used in place of another. Complement is a product that is used together with another product. Aging population is an increase in the average age of the population. Birth rate is the number of live births per thousand of the population in a year. Market supply is the total supply of a product. Extension in supply is a rise in the quantity supplied caused by a rise in the price of the product itself. Contraction in supply is a fall in the quantity supplied caused by a fall in the price of the product itself. Change in supply refers to changes in supply conditions causing shifts in the supply curve. Increase in supply is a rise in supply at any given price, causing the supply curve to shift to the right. Decrease in supply is a fall in supply at any given price, causing the supply curve to shift to the left. Unit cost is the average cost of production and is found by dividing total cost by output. Improvements in technology are advances in the quality of capital goods and methods of production. Direct taxes are taxes on the income and wealth of individuals and firms. Indirect taxes are taxes on goods and services. Tax is a payment to the government. Subsidy is a payment by a government to encourage the production or consumption of a product. Equilibrium price is the price where demand and supply are equal. Excess supply is the amount by which supply is greater than demand. Disequilibrium is a situation where demand and supply are not equal. Excess demand is the amount by which demand is greater than supply. Price elasticity of demand is a measure of the responsiveness of the quantity demanded to a change in price. Elastic demand is when the quantity demanded changes by a greater percentage than the change in price. Inelastic demand is when the quantity demanded changes by a smaller percentage than the change in price. Perfectly elastic demand is when a change in price causes a complete change in the quantity demanded. Perfectly inelastic demand is when a change in price has no effect on the quantity demanded. Unit elasticity of demand occurs when a change in price causes an equal change in the quantity demanded, leaving total revenue unchanged. Price elasticity of supply is a measure of the responsiveness of the quantity supplied to a change in price. Elastic supply is when the quantity supplied changes by a greater percentage than the change in price. Inelastic supply is when the quantity supplied changes by a smaller percentage than the change in price. Perfectly inelastic supply is when a change in price has no effect on the quantity supplied. Perfectly elastic supply is when a change in price causes a complete change in the quantity supplied. Unit elasticity of supply occurs when a change in price causes an equal percentage change in the quantity supplied. Public sector is the part of the economy controlled by the government. State owned enterprises are organizations owned by the government which sell products. Privatization is the sale of public sector assets to the private sector. Price mechanism is the system by which the market forces of demand and supply determine prices. Market failure occurs when market forces result in an inefficient allocation of resources. Free rider is someone who consumes a good or service without paying for it. Allocative efficiency occurs when resources are allocated to produce the right products in the right quantities. Productive efficiency occurs when products are produced at the lowest possible cost while making full use of resources. Dynamic efficiency is efficiency occurring over time as a result of investment and innovation. Third parties are those not directly involved in producing or consuming a product. Social benefits are the total benefits to society of an economic activity. Social costs are the total cost to society of an economic activity. Private benefits are benefits received by those directly consuming or producing a product. Private costs are costs borne by those directly consuming or producing a product. External costs are costs imposed on those who are not directly involved in the consumption and production activities of others. External benefits are benefits enjoyed by those who are not directly involved in the consumption and production activities of others. Socially optimum output is the level of output where social cost equals social benefit and society's welfare is maximized. Merit goods are products which the government considers consumers do not fully appreciate how beneficial they are, and therefore such goods will be underconsumed if left to market forces. These goods generate positive externalities. Demerit goods are products which the government considers consumers do not fully appreciate how harmful they are, and therefore such goods will be overconsumed if left to market forces. These goods generate negative externalities. Public good is a product which is non-rival and non-excludable, and therefore needs to be financed by taxation. Private good is a product which is both rival and excludable. Monopoly is a single seller in a market. Price fixing occurs when two or more firms agree to sell a product at the same price. Rationing is a limit on the amount that can be consumed. Lottery is the drawing of tickets to decide who will receive the products. Nationalization is the process of moving the ownership and control of an industry from the private sector to the government. Public corporation is a business organization owned by the government and designed to act in the public interest. Cost-benefit analysis is a method of assessing investment projects which takes into account social costs and benefits. Multinational companies are companies which produce in more than one country. Thanks for watching.